Many traders focus on indicators and signals, but overlook one of the most important elements: where price is likely to react. Understanding supply and demand zones gives you a clear view of where buying and selling pressure may return, and that insight can make all the difference. In this video, you'll learn how to identify valid supply and demand zones, 4 key price patterns that often precede strong market reactions, how to confirm a zone using price action and market structure, what liquidity sweeps are and how to recognize them, and how to use Fibonacci retracement levels to refine your zones and improve your trade planning. Whether you're refining your strategy or building a solid foundation, this video is designed to help you analyze the market with greater confidence and clarity. Before we jump in, don't forget to like the video, subscribe to the channel, and turn on the bell so you never miss an upload. A supply zone is an area on the chart where sellers step in with enough force to halt the upward movement of price. It typically forms after a strong rally when major players like banks or institutions start offloading their positions to secure profits. This surge in selling pressure causes the market to reverse and drop from that level. On the flip side, a demand zone is where buyers show up in strength, preventing the price from falling further. It usually appears after a downward move, signaling that smart money is entering the market, pushing the price back up. Both zones mark key areas where the market is likely to react, offering valuable clues for potential trade setups. Supply and demand zones don't just appear randomly, they form in recognizable patterns. And if you want to trade like smart money, you need to master these 4 key formations. Let's start with one of the most powerful, the drop-based rally. This is not just a bullish reversal, it's a signature move by institutions. Here's how it plays out. First, the price drops. It looks like a sell-off, but in reality, it's often a trap, a move designed to shake out retail traders and trigger stop losses. Then comes the base, a quiet consolidation where price moves sideways. But this stillness, it's not indecision, it's preparation. This is where smart money starts accumulating, loading up without attracting attention. And then comes the rally, an aggressive move upward as institutions unleash their full buying power. This isn't just a random spike, it's the result of a calculated plan. Push the price down, accumulate at the best levels, then let the market fly. Let's look at a real chart. Notice the drop? It's not just noise, it's a deliberate liquidity grab, engineered to flush out weak hands. The base that follows? That's the hidden battleground. Smart money is building positions while retail traders are confused or scared. They might even see fake signals, thinking price will break lower. But then, the rally hits, and it's fast, because the heavy players are in full control now. This entire structure forms a clear demand zone, a zone where smart money left their fingerprint. And as a trader, you know exactly what that means. When price revisits this zone, there's a high probability it explodes upward again. Why? Because institutions rarely buy everything at once. They scale in, and when price comes back, they have pending limit orders waiting. Meanwhile, retail traders rush in late, placing stop losses too close, giving smart money another chance to sweep that liquidity before launching price once more. That's the exact move we look for as traders, a precise, repeatable edge. But this is just the beginning, only a glimpse of the full strategy. Stick around because in the next section, I'll show you exactly how to trade these zones for consistent, high probability entries. Now, let's flip the script and break down the rally base drop, a textbook bearish reversal pattern. The market climbs, forms a pause, the base, and then plunges. But this isn't random. It's a strategic move, and that base, it's where smart money starts quietly selling into strength. This zone becomes a supply zone, a powerful reference point where institutional footprints are left behind. When price comes back to this level, institutions already have their sell orders stacked. And retail traders? They often place stop losses just above that zone, the perfect target for a liquidity sweep. Once those stops are cleared, the market drops sharply. That's the kind of move scalpers live for. Take a look at this real chart. First, we see a strong rally, likely fueled by institutional buyers, but then price stalls and forms a base. That's the handoff. Smart money begins unloading their positions quietly. The result? A sudden drop as selling pressure takes over. But here's the trader's edge. We don't chase the drop. We wait for the retest. When price pulls back to the supply zone, that's our moment. The institutions often step back in, and we follow, entering with precision and exiting quickly before the market fully reacts. That's how you stay ahead. Next, let's break down the rally base rally. A powerful, bullish continuation pattern. Unlike a reversal, this one signals that buyers aren't done yet. Here's how it works. Price surges upward, then pauses to form a base. But this base isn't weakness. It's a breather, a calm before the next upward push. This pause in price action is where institutions are quietly reloading. They're not exiting, they're preparing for the next move. And when the market breaks out of the base with another rally, it confirms one thing: buyers are still in control. Now look at this chart, a textbook rally-base rally. The market takes off with a strong bullish move, likely fueled by smart money. Then comes the base, a tight consolidation zone. To retail traders, it might seem like the rally is stalling or losing steam, but in reality, this is accumulation, a quiet buildup of buying pressure by those who move the market. This is where trading psychology plays a key role. While the average trader hesitates or expects a reversal, the professionals are positioning themselves for the next leg up. And once price breaks above the base, it's the confirmation we've been waiting for. Momentum is back and smart money is leading the charge. As traders, we don't chase the breakout. We wait for the retest. When price pulls back to the base, that's our entry. A clean, low-risk setup. We get in, ride the momentum, and get out fast, locking in profits before the crowd catches on. Finally, let's break down the drop-base drop, a powerful bearish continuation pattern. It starts with a clear downward move, showing that sellers are firmly in control. Then, price pauses and forms a base. But don't be fooled. This isn't a reversal, it's a setup, a moment where institutions are quietly preparing for the next wave of selling. Once that preparation is done, the market drops again, sharply. This continuation move confirms that the selling pressure hasn't eased. That base in the middle? It becomes a supply zone, a key level where smart money unloaded some of their positions and may be planning to re-enter. Let's zoom in on a real chart. First, you'll spot the strong drop, a clean, impulsive move downward. Then comes the base, a moment of calm that hides what's really happening. Institutions are stacking up their sell orders here, but they do it quietly, without disrupting the market. You see, smart money never sells everything in one go. That would tip their hand. Instead, they sell in waves, allowing liquidity to build, manipulating retail traders into thinking the drop is done, and then striking again. That second drop seals the pattern, the drop-base drop, a clear institutional signature. For traders, this setup is gold. Our job is to mark the supply zone created by the base and wait for price to revisit it. Once the market pulls back into that zone, that's when we consider jumping in with speed and precision. But here's the thing, it's not as simple as waiting for a retest. There are key conditions and details that must align before you take the trade. Here's the truth, some zones are powerful, others weak and unreliable. The difference comes down to 4 key filters. And once you learn to apply them, you'll stop wasting time on low-quality setups and start focusing only on the zones that deliver real results. The first filter is candle size. When institutions step in, they leave a trace, and one of the clearest signs is the size and consistency of the candles. If you see large candles moving in the same direction, clean and confident, that's smart money at work. But if the candles are small, choppy, or full of wicks, that's noise, weak momentum, and it's a setup you should ignore. The second filter is freshness of the zone. Only trade zones that haven't been touched before. Why? Because the first test is the most explosive. Once price revisits a zone, its power fades, and the odds of a clean bounce drop sharply. Especially on the 5-minute chart, you'll see tons of zones. This filter helps you eliminate the stale ones. The third filter is break of structure. A high-quality zone often forms after price breaks through a significant level, like a previous high or low. That breakout, it's not random. It's a move designed to grab liquidity, trap retail traders, and shift market structure. When a zone is created after such a breakout, it's a strong clue that smart money is in control, and that makes it worth watching. The fourth filter is risk to reward ratio. Never trade a zone unless it gives you at least a 3-to-1 reward to risk. If your potential profit isn't 3 times your risk, it's not worth it, no matter how clean the setup looks. Why? Because over time, poor risk to reward will destroy your edge. Discipline is what separates winning from the rest. So remember, big candles, fresh zones, break of structure, and a minimum 3-to-1 reward to risk ratio. These 4 filters are your foundation for spotting only the best supply and demand zones. Lock them in, because what comes next will show you exactly how to trade these zones like a pro. Now it's time to apply everything we've covered. Let's break down a real chart example and see if the demand zone in front of us checks all the boxes of a high probability setup, or if it's one to avoid. Take a close look at this zone. First thing to notice, the candles. We've got large, powerful, bullish candles moving in one clear direction, with very few wicks. That's exactly the kind of price action that signals institutional buying. Big players don't tiptoe into the market, they move with size, and these candles reflect that. Next up, freshness. Has this zone been tested before? No, this is a fresh demand zone. And that's key. As we've said before, the first touch of a zone is usually the strongest. Once a zone is retested, its reliability drops. So this untouched zone gives us a strong reason to pay attention. Now, let's check for a structural breakout. Did price break through any significant level? Absolutely. You can see that it pushed above a previous resistance and printed new highs. That's not a random move. That's smart money engineering a breakout, trapping late sellers and clearing liquidity. It's another clue that this demand zone was created by real buying pressure. And finally, the risk to reward. From this entry point, the setup offers a clean 4-to-1 ratio. That means for every unit of risk, you're targeting 4 units of reward. Exactly the kind of math that keeps your edge strong over time. Even if not every trade wins, this ratio keeps you profitable in the long run. So let's review. Strong, clean candles, showing institutional momentum, a fresh, untouched zone, not yet weakened by multiple tests, a break of key market structure, confirming directional intent, a solid 3-to-1 risk-to-reward ratio, giving the trade real potential. This demand zone ticks every box. It's not just a good setup, it's a high-probability trade that deserves serious attention. By now, you've learned how to identify supply and demand zones and spot the high-quality ones. That alone puts you ahead of most traders. But if you really want to trade like smart money, there's one more layer you need to master. The second confirmation. I call it the liquidity sweep. So what exactly is a liquidity sweep? It's a tactic used by market makers and institutions to trigger retail stop losses, fill their own limit orders, and get in at the best possible price. Here's how it usually plays out. The market breaks above a resistance level. Retail traders jump in, thinking it's a breakout. Then price pulls back to retest that same level, which is now seen as support. This area becomes loaded with stop losses and pending buy orders. A perfect target. So what do the market makers do? They push the price below support, triggering stops and sweeping liquidity. Then they reverse it. Right after grabbing that liquidity, the price shoots back in the opposite direction. It's a trap, a reset. And it's exactly how institutions get their positions filled before the real move begins. Now, let's look at a real chart example. We've identified a strong demand zone. Price previously rallied from this level with momentum, showing clear interest from institutional buyers. Eventually, price returns to this zone. At first glance, it looks like a potential bounce. But here's where the trap is set. Instead of respecting the zone immediately, price breaks below the demand zone. This move triggers stop losses from retail traders who entered early expecting a clean bounce. Their stops are usually sitting just below the zone, and market makers know that. Then comes the key detail. The candle closes back above the zone. This is a clear liquidity sweep. Smart money just grabbed liquidity, filled their buy orders at a discount, and rejected the breakdown, signaling a strong reversal ahead. When this happens at a demand zone, it's not random. It's a sign that institutions are paying close attention. And if they are, so should you. Because our goal is simple. Stop trading like retail and start trading with the ones who move the market. Now let's move to the next crucial step, price action confirmation. When a liquidity sweep occurs, it doesn't just grab stop losses. It often leaves behind a clear signal, a footprint in the form of a candlestick pattern. And for this strategy, we focus on 2 simple but powerful confirmation signals, the pin bar and the tailed bar, which can sometimes appear as dojis with strong wicks. Let's start with the pin bar, one of the most reliable signals to confirm smart money interest. A pin bar is a candlestick with a small body and a long wick or tail. The small body shows where price opened and closed during the candle's time frame. The long wick represents how far price tried to go before getting rejected. So what's the message behind a pin bar? It tells us that price attempted to move in one direction, but was quickly shut down by strong opposing pressure. That rejection is key. It signals that the initial move was likely false and price is about to reverse. Now let's connect this to a bullish pin bar at a demand zone. Here's what's happening behind the scenes. Smart money drives price down into the zone, sweeping liquidity by triggering stop losses and filling limit buy orders. But once price enters the zone, strong buyers step in and reject the lower prices. That rejection forms the long lower wick of the pin bar. The small body shows that even though price dipped, it closed back near the highs, a sign of strength. This is a clear message. The zone has absorbed selling pressure, and buyers are now in control. This is exactly the kind of confirmation we wait for. When you spot a bullish pin bar after a liquidity sweep into a demand zone, that's your cue. Smart money is active, and the zone is now validated. It's a strong opportunity to enter a long position with confidence. And for a supply zone, it works the same way, but in reverse. Simply wait for a bearish pin bar that forms after a liquidity sweep above the supply zone. Now let's introduce the second confirmation signal, the tailed bar, also known as a rejection candle. A tailed bar is a candlestick with a small or big body and a long tail extending from one side. It might not look as dramatic as a pin bar, but it tells the same story. Price was pushed into an area, rejected hard, and reversed. Let's apply this to a demand zone. When price moves into the zone or even dips slightly below it, smart money often triggers a liquidity sweep to absorb selling pressure. The tailed bar forms when buyers quickly step in and reject the low, leaving a long lower wick behind. The candle closes back inside or above the demand zone. That's the key. It tells us that the zone is still valid and respected by institutions. And yes, even a doji can serve this purpose if it has a strong tail. In this case, the long lower wick shows rejection, while the small body signals indecision. Perfect context after a liquidity sweep. When you see this kind of tailed bar after a sweep, it's a clear message. Smart money has absorbed liquidity, and the market is ready to reverse upward. That's your cue to prepare a buy entry, not based on hope, but on clear price action confirmation. Now let's take a look at a tailed bar forming at a supply zone. In this case, smart money pushes price above the supply zone, triggering stop losses from short sellers and activating buy orders from retail traders who believe it's a breakout. But it's not. The market immediately rejects those higher prices, and that rejection leaves a long upper tail on the candle. This is your signal that sellers have stepped in aggressively after the liquidity sweep. The body of the tailed bar closes back inside or below the supply zone. That's the critical part. It tells you that the move above the zone was a trap, not a breakout. This rejection confirms that smart money is still defending the zone, and the market is likely to reverse downward from here. So what does this mean for you? When you see a tailed bar with a long upper wick closing back inside a supply zone after a liquidity sweep, it's a clear, high probability signal to enter a sell trade. You're not guessing. You're reacting to evidence that institutions have taken control, and you're positioning yourself with the smart money, not against it. Now that you know how to identify high probability supply and demand zones, let's take it one step further and talk about something I call the golden zone. Golden zones are areas that align with the 50% or 61.8% Fibonacci retracement levels. When a valid supply or demand zone forms around these levels, it's considered a golden zone. Let's break this down with a real chart example of a demand zone. We start by identifying a clean demand zone that meets all our key filters. Strong bullish candles, fresh and untested zone, break of structure to the upside, and a 3-to-1 risk to reward ratio. Now we add the Fibonacci retracement from the swing low to the swing high that created the demand zone. And look at this. The zone aligns perfectly with the 61.8% and 50% retracement level. That's a strong confluence, and this is what we call a golden zone. But remember, even with Fibonacci lining up, we never trade blindly. We wait for our second confirmation, the liquidity sweep, followed by a confirmation signal. Watch what happens. Price dips below the demand zone, sweeps liquidity, then prints a bullish pin bar that closes back inside the zone. Right after that, price explodes upward. This is the ideal scenario. A demand zone that meets all four key criteria and sits in the golden zone. But here's the warning. If the zone is weak, no structure break, no clean candles, no fresh test, then even if it sits at the 61.8% or 50% Fibonacci level, it's not worth trading. Fibonacci is a tool for refinement, not a reason to trade on its own. Now let's flip it and look at a supply zone using the same logic. We identify a clean bearish move with large bearish candles. Fresh supply zone, break of structure to the downside, and good risk to reward ratio. Next, we plot our Fibonacci retracement, this time from the swing high to swing low. What do we see? The supply zone sits right in the golden zone, between 50% and 61.8% Fibo levels. Now we wait. Price climbs back into the supply zone, and just above it we get a liquidity sweep. Then a doji bar forms, a long wick rejecting higher prices and closing back inside the zone. That's our confirmation. Smart money has stepped in, absorbed buy-side liquidity, and is ready to drive the market down. And just like that, price reverses sharply. Once again, the key is not the Fibonacci level alone. What truly matters is the combination of factors: an institutional zone, alignment with the golden Fibonacci level, evidence of a liquidity sweep, and clear price action confirmation. Together, these elements create a high probability trading setup. That's it for this one. If you got value, smash that like button, subscribe if you haven't already, and hit the bell so you never miss a new video. Thank you for watching and see you in the next video.